Today, we are diving into the core concepts of risk management and the specific types of risk you must master for the national portion of the life insurance exam. The foundation of all insurance theory rests on your ability to differentiate between pure risk and speculative risk. On your exam, you will likely see a question asking which of these is insurable, and the answer is always pure risk, because it only involves the chance of loss or no loss with no possibility of financial gain. Imagine a homeowner's house burning down or a breadwinner passing away prematurely. These are pure risks because there is no way for the person to profit from the event occurring. Conversely, speculative risk is something like gambling at a casino or investing in the stock market, where there is a very real chance for gain. Insurance companies will never cover speculative risks because they are not in the business of subsidizing your bad bets or investment losses. When you see a scenario on the exam involving a business venture where a profit could be made, immediately classify it as speculative, and remember it is uninsurable. To manage these risks, you need to memorize the STAR acronym, which stands for sharing, transfer, avoidance, retention, and reduction. Let us break these down from an exam perspective, because the test will try to trip you up on the nuances. Risk sharing involves a group of people collectively bearing a loss, such as in a formal partnership or a reciprocal insurance exchange. Risk transfer is the most common method you will deal with, because this is what happens when someone buys an insurance policy. The individual pays a premium to shift the financial burden of a potential loss to the insurance company. If you see a question about moving the financial consequences of a loss to another party, the answer is transfer. Risk avoidance means simply not engaging in a hazardous activity at all, like refusing to drive a car to avoid the risk of an accident. While effective, it is often impractical, so look for keywords that imply a total cessation of activity. Risk retention, or self-insurance, occurs when a person or business decides to pay for losses out of their own pocket. On the exam, a common trap is seeing a deductible described as a form of risk management. A deductible is actually a form of partial risk retention because you are choosing to pay that initial amount yourself. Risk reduction involves taking steps to minimize the severity or frequency of a loss. Installing smoke detectors or joining a gym to improve health are classic examples of risk reduction. You must be able to identify which STAR method is being used in a specific scenario. A frequent exam trick is to provide a scenario where someone installs a sprinkler system and then buys insurance. The exam might ask what methods are being used, and the correct answer would be both reduction and transfer. Always remember that insurance is specifically designed to handle pure risk through the mechanism of transfer. If you can keep the STAR acronym in your head and remember that speculation is never insurable, you will navigate these questions with ease. To truly master these concepts for the national exam, you must look closely at how the questions are structured. You might encounter a question that asks which of the following is not a characteristic of an insurable risk. In that scenario, the exam is testing if you know that speculative risks are excluded. If the option involves a potential for profit, it is the wrong answer for insurance coverage. Another area where students struggle is the difference between sharing and transfer. Sharing involves a group of individuals, like members of a reciprocal or a Lloyd's association, who agree to divide any losses among themselves. Transfer is the act of moving that risk to a separate legal entity, the insurance company, in exchange for a premium. You should also watch out for the phrasing around risk retention. If the exam mentions a large corporation that sets aside a fund to pay for its own workers' compensation claims, they are testing your knowledge of retention or self-insurance. It is also important to recognize that risk avoidance is the most extreme measure. If the question describes someone quitting a high-risk hobby, like skydiving, to eliminate the chance of an accident, that is avoidance. If they instead buy a high-quality parachute and better training, that is reduction. The nuances between these 5 methods are where the points are won or lost. Always ask yourself if the person is doing something to make the loss less likely, which is reduction, or if they are simply accepting the loss, which is retention. By understanding that insurance is a mechanism for handling pure risk through transfer, and by applying the STAR acronym to every situational question, You will be well prepared for any risk management questions on the national portion of the life insurance exam.